Hello all! You need to hear this if you're a history buff. History whispers a tale of booms and busts, of exuberant highs and devastating lows. The annals of finance are littered with stories of crises that shook the foundations of economies and societies. These moments of chaos and uncertainty, however, often serve as crucibles, forging new systems and innovations from the ashes of the old. From the tulip fields of 17th century Holland to the global financial meltdown of 2008, each crisis has forced a reckoning, a re-evaluation of existing structures, and ultimately a birth of new financial paradigms. Can we learn from these historical patterns? Can we understand the forces that drive innovation in the face of economic turmoil? In the Dutch Golden Age, a period of unprecedented economic prosperity and cultural flourishing, the Netherlands experienced a remarkable transformation. During this time, a peculiar flower became the object of intense speculation and fascination. Tulip bulbs, prized for their vibrant colours and exotic origins, became symbols of wealth and status among the Dutch elite. As demand for these bulbs soared, so did their prices, creating a speculative bubble that would eventually burst, leaving financial ruin in its wake. The frenzy reached its peak in the winter of 1636 to 1637. The Dutch Tulip Mania, often cited as the first recorded speculative bubble, had a profound impact on Amsterdam's financial system and the psyche of its people. In the aftermath of the crash, a need for greater financial stability and regulation became apparent to prevent such economic disasters in the future. This led to the establishment of the Amsterdam Wisselbank in 1609, one of the world's first central banks, which aimed to bring order to the chaotic financial environment. The Wisselbank's primary function was to provide a secure and reliable system for exchanging currency, which was crucial for the thriving trade in Amsterdam. At the time, a multitude of different coins circulated in Amsterdam, many of them foreign, making trade and commerce cumbersome and confusing for merchants. The Wisselbank introduced a system of standardized accounts, allowing merchants to deposit their various coins and receive credit in a stable unit of account, known as the bank guilder. This innovation facilitated smoother transactions and reduced the risk associated with handling multiple currencies, thereby boosting confidence in the financial system. The Wisselbank also played a crucial role in extending credit to the Dutch government and managing public debt, which was essential for funding public projects and military campaigns. Though not a central bank in the modern sense, the Amsterdam Wisselbank laid the groundwork for future institutions that would play a critical role in stabilizing economies and managing financial crises. The lessons learned from the Tulip Mania and the subsequent establishment of the Wisselbank highlight the importance of financial innovation and regulation in response to crises. The need for stability, transparency and trust in financial systems became increasingly clear as economies grew more complex and interconnected, setting the stage for the development of modern central banking. The Panic of 1873, triggered by the collapse of the J. Cook and Company, a prominent investment bank, sent shockwaves through the American economy. This event marked the beginning of a severe financial downturn that would have lasting impacts on the nation's economic landscape. The ensuing depression exposed the fragility of the nation's rapidly expanding railroad system, a key driver of economic growth at the time. Railroads had been the backbone of American expansion, connecting distant regions and facilitating commerce. But their overexpansion now revealed significant vulnerabilities. With overextended railroads facing bankruptcy, the financial system teetered on the brink, threatening to plunge the country into a deeper crisis. The collapse of these railroads not only affected the transportation sector, but also had a ripple effect on industries reliant on rail transport. Amidst the turmoil, a new breed of financier emerged, the investment banker. These individuals were not just financiers, they were visionaries who saw opportunities where others saw only chaos. These individuals possessed the financial acumen and connections to navigate the complexities of a rapidly industrializing economy. They understood the intricate balance between risk and reward, and their strategies would come to define modern finance. One such figure, John Pierpont Morgan, rose to prominence during this era, playing a pivotal role in reorganizing the nation's troubled railroads. Morgan's influence extended beyond mere financial restructuring. He was instrumental in shaping the future of American industry. Morgan recognized that the overbuilding of railroads, coupled with poor management and speculative financing, had created a crisis of solvency. He saw the need for a more sustainable approach to railroad management and financing. He saw an opportunity to consolidate the industry, bringing order to the chaos. By merging smaller, struggling railroads into larger, more efficient entities, Morgan aimed to create a more stable and profitable transportation network. Through a series of complex financial maneuvers, Morgan orchestrated mergers, restructured debts, and injected much-needed capital into the struggling railroads. His actions not only saved many railroads from collapse, but also set a precedent for future financial interventions. His efforts helped stabilize the industry, prevent a complete collapse, and laid the foundation for a more efficient and profitable transportation system. The restructured railroads became a model of efficiency and reliability, contributing to the nation's economic recovery. The Panic of 1873 and the emergence of investment banking marked a turning point in American finance. This period highlighted the critical role of financial institutions in managing economic crises and fostering growth. The crisis demonstrated the growing importance of sophisticated financial institutions capable of managing large-scale capital flows and restructuring troubled industries. These institutions became the backbone of the modern financial system, providing the necessary support for industrial expansion. Investment banks, like the House of Morgan, played a crucial role in shaping the modern American economy, financing the growth of major industries and influencing the course of business. Their legacy continues to influence the financial world today, underscoring the enduring impact of the Panic of 1873. The stock market crash of 1929 ushered in the Great Depression, a global economic crisis of unprecedented scale and severity. The sudden collapse of the market sent shockwaves through the financial world, leading to a cascade of economic failures. The collapse of the stock market exposed deep-seated weaknesses in the financial system, leading to bank runs, widespread unemployment, and a sharp decline in economic activity. Banks failed by the thousands, and millions of people lost their life savings, plunging them into poverty. The crisis shook the foundations of capitalism, forcing governments to rethink their role in regulating the economy and providing for the welfare of their citizens. Protests erupted across the nation, demanding action and relief from the government. In the United States, President Franklin D. Roosevelt responded to the crisis with a series of programs and reforms known as the New Deal. These initiatives aimed to stabilize the economy and provide jobs and relief to those suffering. The New Deal aimed to provide relief, recovery, and reform to the battered American economy. Public works projects were launched to create jobs, and various agencies were established to oversee economic recovery. One of the most significant legacies of the New Deal was the establishment of social safety nets, programs designed to provide a safety net for citizens facing economic hardship. These programs included unemployment benefits, social security, and various forms of public assistance. The Social Security Act of 1935 established a system of old age pensions, unemployment insurance, and aid to families with dependent children. This act was a landmark in American social policy, providing a foundation for future welfare programs. This marked a fundamental shift in the relationship between the government and its citizens, with the government taking on a more active role in ensuring economic security. The New Deal's social programs helped to alleviate the suffering of millions and laid the groundwork for a more robust social safety net. Another crucial innovation of the New Deal era was the creation of the Federal Deposit Insurance Corporation, or FDIC, in 1933. This institution was designed to restore trust in the banking system by insuring deposits, thus preventing the widespread bank runs that had devastated the economy. The FDIC was established to restore confidence in the banking system by insuring bank deposits, thereby preventing bank runs that had plagued the early years of the Depression. This measure was instrumental in stabilizing the financial sector and protecting individual savings. These reforms, born out of the ashes of the Great Depression, fundamentally reshaped the American financial system, providing greater stability and security for millions of citizens. The New Deal's legacy is evident in the enduring institutions and policies that continue to support economic stability and social welfare. The New Deal era demonstrated the crucial role of government intervention in times of crisis and the importance of social safety nets in mitigating the impact of economic downturns. It set a precedent for future government action in times of economic distress, highlighting the need for a balanced approach to economic management and social welfare. Thanks for joining me on this historical journey. If you enjoyed this trip back in time, don't forget to like, share, and subscribe for more fascinating history bites. Until next time, keep exploring,